I need to ask you about this, just the events these last 2 weeks or so.
Yeah.
Are we done? Like, are we past the worst, or do you feel like things get a little bit worse before they get eventually better, hopefully?
I hope we're through the worst. I mean, I think there's still some questions around business models around the world. Have there been weaknesses that have been exposed in the business models of any of the companies that have had trouble that need to be addressed at this point? But it certainly seems that the acute phase of the crisis is done.
A lot of this comes down, I was listening to the panel that you just came from, of course. There's one part is liquidity issues, right? And the other part is confidence, really. And that's really how you stitch together what happened in the US to what took place in Switzerland, of course. Have you heard enough from regulators to be able to address, do you think they've done enough to sort of bolster confidence at this point in time?
I think regulators have taken extraordinary steps, first in the US and then obviously subsequently in Switzerland, to make sure that the banking system stayed safe while individual banks had their troubles. Obviously, we'll all be reflecting on what could we have done to prevent this, because you never want to get to the point where you have to take the actions that the Fed and the FDIC took in the US, or that the regulators in Switzerland took. You don't want to get there in the first place. But once there were relatively few choices, and I think they pulled out the big guns and they calmed the markets. And that's, at that particular point, that's the critical thing, and I think they succeeded.
One of the sort of side effects we've seen is this sort of almost transfer of I would say, transfer of deposits from the smaller lenders into the big ones. And I would imagine, of course, we would consider you as one of the big ones. Have you seen any of that these last few weeks or so? Have you seen a lot of inflows, whether that's client funds or just clients themselves, client accounts?
Yeah, I mean, look, we were very well capitalized going into this period of turmoil. Obviously not expecting the turmoil itself, but we were very well and very liquid. And we've had we have an extremely liquid balance sheet and have had for years. So I don't think it's appropriate for any of us to say that we benefited from this, because overall I don't think any of us have benefited. But in terms of the resilience of our business, it's been evidence, and of course that's a good thing.
When the markets are trying to figure out whether we're past this, so they look at things, for example, we got the data from, I think it was the Fed a couple of hours ago. Another week of banks in the U.S. at least tapping the discount window. That's one. You're seeing credit default swaps still on the way up. I mean, should these things still concern us, or are these still remnants that eventually you think go away?
I think we have the flow through from the acute phase of the crisis. So we saw the Fed hike to 25 basis points. The market not too long ago had been thinking 50 basis points. It would seem to be a nod, and in fact it was, at least in part, a nod to financial conditions, and which means that the Fed is fighting two different fights that may be conflicting, with financial condition management on the one hand and inflation on the other. Sustained higher inflation is not a good thing for any of us, right? I mean, we want inflation to be back under control. So I think the Fed has a particular challenge in now managing two reasonably pressing challenges that are coming at them. I think they're striking the right balance, but there will be implications. The implication will be, on the assumption that this financial turmoil doesn't flow through to the real economy, and that's a big question. I mean, are we going to lose, is there going to be a real economy impact in the US or in Switzerland or elsewhere in the world as a result of the failure and seizure of these banks, or the challenges to business models for other banks? Short order, it would appear to be no. Longer term, it could be, if the market is deprived of some lending capital that can't be replaced by other banks or by capital markets. Now, I suspect that it will all be replaced by banks and capital markets, but we'll see.
And that takes us into some of the lessons, perhaps the lessons for potentially, hopefully, we're going to learn from this. Are there business models out there that you think are just not sustainable, given, of course, hindsight, but given what we know right now? We need to revisit some of these things, for example. And maybe also from a regulatory perspective, is there a role there too for new regulation?
I wouldn't generalize about business models that are not sustainable. I think there are some truisms in banking on which we have to reflect. You've got to keep your deposit base diversified, and you've got to keep your balance sheet liquid. Right? I mean, it's a truism in banking. Of course, in the age of social media and bank runs by Twitter or whatever the phrases are that get used, we have to reflect on whether we've all really accomplished everything that we know we must accomplish. And, I feel very confident that Standard Chartered has done the right thing and is in the right place. I think most banks are. There may be some that need to adjust their business models, and I'm sure those are in the process of being adjusted. And the regulators and central banks have given the market time to adjust those business models by taking some pretty extraordinary steps with deposit guarantees and extraordinary liquidity facilities and things like that.
Yeah, and a lot of your peers have had to have really difficult conversations these last, I guess, few weeks. So I'll ask you directly and unequivocally, are you having to do any out of the ordinary liquidity controls right now or risk controls right now? You guys are in a fine place.
No, we're in a fine place. I mean, if you start in the right place, these periods of turmoil are not as painful as if you start in a less good place. And we started in a very good place.
Right. Now, where do you think we go with the AT1 bond conversation? Because certainly there's one aspect, which is how do you get wiped out like that? The other thing is how do you get from that point to one point without even having a conversation around who made that decision to wipe things out, for example?
No, I think those are questions that will be asked for some time. And at the end of the day, banks have equity, and then they have other bail-in securities, and the amount of bail-in securities I think ranges from something like 5% to 15% of the overall capital. So it's not huge in the overall scheme of things. It's cost-effective for banks because these are debt securities which carry a lower coupon than the cost of equity. And no surprise in the immediate aftershock from the Credit Suisse events. The effective yield on these AT1 instruments was the same as the cost of equity. Right. Everything was moving around, so we can't be very precise. But no surprise, it was treated like equity, so therefore the market's going to trade it like equity. It doesn't make sense. If you think that the hierarchy of equity first and debt second is going to be respected in future, and of course the Bank of England and the ECB have come out and said very clearly that they will respect that particular hierarchy, then the AT1 should trade at a lower return than the cost of equity. But
in an ideal situation, of course.
Yeah, right. but the market's going to want some confidence, so that's the case. Right. And as I just mentioned in the panel inside, one of the key questions for regulators is, how are you going to assure the market that both these instruments are valuable in the sense that they're less risky than the equity? And second, how are you going to give the market confidence that the process that you go through before these AT1s are bailed in or wiped out in banks that appear to be solvent is an appropriate process? Because these are things that leave questions in the market. So right now the AT1s are a lot more expensive, expensive for us as an issuer, cheaper to own than they were before, and that may be where we end up. And if it is, then the market will re-equilibrate.
Does it make you rethink? Well, I guess for one, do you expect your funding costs to go up almost semi-permanently because of the premium that's been built into the markets right now? That's one. And does it make you rethink using that as a funding source, I guess, is the other question too?
Look, I think that the market has given its verdict quite clearly that the cost of equity for banks has gone up. And that's, our share price is while partially recovered, is still below where it was prior to all these events happening, even though the events had nothing to do with us and were not impacted either directly or even indirectly if we assume that the economic impact is going to be minimal. Why would our share price go down? Well, because the market has said your cost of equity has gone up. I think regulators should be concerned about that. The cost of equity for banks is already quite high. High cost of equity for banking means less credit available for the market, for the real economy. So I think regulators should be concerned about that, and they should be taking steps to offer the transparency that will allow investors to say, this is how these things are going to work in the situations that I might be concerned about. Not to overtly reduce the cost of equity, but to take the equity risk premium out as a result of uncertainty.
As you perhaps alluded to earlier, everyone's become almost a banking analyst, right? From the real ones all the way to Twitter, for example, right? Well, one of the things that's really come up also recently, talking about funding costs, is just the rates available on deposits, for example, has, I wouldn't say scared away people, it's disincentivized them from keeping them there. And obviously the crisis of confidence has pushed that too into sort of money market funds. Is that, well, for one, is that something you're worried about? Number two, does that incentivize you to increase then at least your costs, your funding costs, for example?
Yeah, we have a very strong deposit base, and people deposit money in banks for different reasons. Sometimes they've got surplus funds, and it feels like a good place to park your money. Of course, if it becomes too expensive to leave your money in a lower returning bank account, you'll either move it into a time deposit or you'll move it out into some other security.
Right.
And that's absolutely ordinary course. And interestingly, up until this turmoil period, this crisis period, depositors, consumers, have behaved pretty much along the lines that we would have expected. Now, that said, the rate rise was unprecedented in its pace. So we don't have models that say this is the way people respond when you increase rates by 400 basis points in a year. That has not happened. But it felt pretty much in line with what we expected, very much in line with our own modeling, which we had communicated to the market. We have seen no extraordinary migration of money out of bank deposits during this period of turmoil. In fact, the opposite. I think the big, well-capitalized banks have similarly not had any deposit stress. I don't know. Well, we know you mentioned that the discount window borrowings, smaller borrowings under this concessionary Fed facility for sort of to top up the
the new one.
Okay,
yeah.
I can't remember what it's called, but the new one. I haven't seen the latest usage stats there. It was less than the discount window borrowings, but but clearly some banks are feeling the need to access those facilities. Now, those are U.S. specific programs. I'm not aware of material discount window borrowings or equivalent outside of the U.S. So it doesn't appear to me that this is in any way global or systemic.
Okay. Back to the sort of monetary policy part of the conversation. I mean, part of that is divorced from this in the sense that there is an inflation problem that they still need to address. Part of that also, what's happened recently, I guess, in some ways, makes them reflect on have we gone too far, too quickly. What's your sense of where we are? Are we near the end of this tightening policy? Bank of England, the ECB, and the Fed, for example, just to be more specific.
Yeah, I mean, I think these are different markets, but when I look at the real economy in the U.S., it's quite strong. And as recently as yesterday, with better than expected jobless claim numbers again, it just suggests that the underlying job market and economy is quite robust and in quite rude health. And inflation prints are, while trending down as the energy price spike from last year is beginning to recede into the core, inflation's still there. So it does not feel like we're quite at the end of the ending cycle. Now, maybe there's going to be an economic flow through from this banking turmoil. As I said, it's not obvious to me that it's going to be material, but if there was, then that would be a good reason for the Fed to say, okay, let's just take a step back. Okay. But it feels like we've got a little bit further to go.
Now, let's focus in on your business. You're in this part of the world, and before I guess we talk about what you can do yourself, there's big transactions, put it that way, in Switzerland between the two banks, of course, UBS and Credit Suisse. Not to comment directly on those, but how do you think that affects the competitive landscape, particularly in investment banking and wealth management in this part of the world?
I think it really depends on what UBS does with their newly acquired Credit Suisse business. Obviously UBS is a very strong wealth manager. Credit Suisse also had a strong wealth manager. One would assume that they intend for the combined entity to maintain all of that market share. But I guess customers will around the world who maybe had an account at both, and I assume many did, might say, yeah, I wouldn't mind having a second bank. I had two banks before, or three or four, and I'd like to replace that. I guess that will happen. We're certainly very focused on as we have been for some time, further penetrating our customer base in terms of our own wealth management products, in particular in Asia, Middle East, and Africa, where we operate. We've got a super strong business that has seen material net new money inflows over the past several years. I guess that's going to be maintained in part because of that. Yeah, maybe the bigger uncertainty is what happens to that bit of what I think Credit Suisse was beginning to call First Boston, that was going to be spun out or sold out of Credit Suisse. What happens to that now? And that UBS will have to decide whether that structure or some other structure makes sense, or do they keep it and try to incorporate it into their own investment bank?
I'm not trying to get a headline out of you, but just in case, theoretically speaking, if UBS said some of these EM assets kind of don't make sense under our book, for example, would StanChart be, I guess, open to looking at some of these CS assets in the event, of course, that is the scenario moving forward? Yeah,
no, we've always been interested in looking at things on which we could get a decent return and which are strategic for us. So if there are some of those things, yeah, sure, we look at it.
You're headed to where after this?
Beijing.
Okay, what's up there?
China Development Forum.
Yeah.
So first time in person in 3 years. My first time back in China since early 2020. So I'm looking forward to a visit back to China.
Okay. Your key priority for that specific business right now, onshore? Apart from bolstering, of course, morale of your team, of course.
Yeah. Our China business has grown extremely well. Even last year, during all the travail around COVID, we generated 10% growth onshore and 25% growth offshore, right? And our business is a little bit more offshore than onshore. So it's a super strong, fast-growing business. The economy is now kicked back in full speed. Now we're looking at close to 6% growth this year in China. The numbers that are coming in are supporting now that forecast. And so I'm quite keen to just get the lay of the land, reacquaint with old friends, meet some of the new people, because of course there's been a lot of personnel moving around in China, and obviously just to see the team and see some clients.
Bill, have a great trip.
Thank you.
I know you have a client to catch up. We won't keep you here. Bill Winters there, Group CEO of Standard Chartered.